We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Mark Knaus of Decker Retirement Planning. I always say this, you can always go to the website to learn more about the team, Brian, Mark, Brad, all the guys at Decker Retirement. You just go to the website, deckerretirementplanning.com. But on that website, you can also find, under the heading of Safer Retirement Education, you can go, there are about 12 different things you can download, and it's really just stuff that's all for your information. There is a checklist challenge. Like there's 35 things. If you can check them all off, you're probably good to go for retirement. Where are you on that checklist challenge? There's a sample income plan. There's a 3 principles of retirement book. There's Brian's book on retirement. The Decker approach. That's just 4 of the 12 things you can download. So those are on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. Download any or all. It's all there for your information. And of course, if you want to talk with the team, you got questions, and Brian and Mark and the gang, they always cover a lot of ground on this show. You can always write down the number. It's 833-707-3030, 833-707-3030. There's no cost to you. But it is an opportunity for you to get some clarity. Well, hey, Brian, what you were talking about that day, how does that pertain to my situation? Because that's at the end of the day what we're concerned about. Well, our money lasts as long as we need it to. We don't care about our neighbors. It's about us. So this certainly, the planning process is about you. How can the team help? Can they? They don't know if they can until you reach out. So again, welcome, Brian and Mark. I'm glad you're here. We're going to be talking about what kind of topic? Valentine's Day weekend. And we're in that kind of time frame, and it's losing the spouse today, huh, Brian?
Yeah, so the single listeners won't have much to learn about here, but the married and the spouses that are married filing jointly, this is going to be a tax-focused, benefit-focused radio show today, and a lot of things that most people don't know. We have a very smart audience, I know, but this is worth taking out a piece of paper and a pen and jotting some notes. And Mark at Decker Retirement Planning he's our strongest tax and benefit CFP. So we have a good team today. So when a spouse passes, how do you protect your financial future? So Mark, let's start at the top. Financial planning for widowhood, and that affects women more than men because of longevity, but applies to everyone. There's many of our clients where the woman had passed before the man. But what are the immediate financial steps that need to be taken after the loss of a spouse? Like let's start with Social Security.
Yeah, Brian, unfortunately, being in the financial planning world, we see this quite a bit. And some of our best clients that we've had for decades, eventually one of them passes on, and that's really where we find a lot of value for our clients, is helping them navigate this process, moving from being married to now being a widow or a widower, and how do we transition into that phase of life. So you mentioned Social Security. Obviously, Social Security has its own rules and has its own programs and how it deals with these benefits that the surviving spouse has. So the first thing you want to do is notify them of the passing of the spouse. If you don't, and they continue to send you those monthly checks, then they penalize you later on, and they can come back and they can reclaim all of that income that they passed on to you as a lump sum. And that can be very painful if you're just trying to get through the month from a financial or from a money flow perspective. And then all of a sudden Social Security comes and says, you owe us thousands of dollars for benefits that we need to claw back. It can be really, really difficult. So make sure that you notify Social Security and also pensions. If your husband or your spouse had a pension coming to them, the same thing applies. You need to make sure that you notify them so they don't continue sending you that monthly income that you have coming in. When it comes to Social Security, we often have this discussion with our clients about timing. When is the right time to start taking benefits and how does that work? Social Security has a unique feature to it in that upon the passing of the first spouse, the surviving spouse is entitled to the larger of the two benefits. So the smaller benefit goes away, but the larger benefit continues on to the surviving spouse, which is really beneficial.
Okay, Mark, let me jump in and add a couple of things because you talked about immediately notifying Social Security the death of a spouse.
Mm-hmm.
If the payment was deposited for the month of the death, it has to be returned. So that gives you a time frame. The payment is got to be returned for the month of the death. The second thing is there's a small death benefit from Social Security. Guess how large, Mark? It's $255. It's small, but you don't want to miss it.
Right.
You're eligible if you were living together or already receiving spousal benefits. The deadline is 2 years after death. You can apply and get that $255. But the biggest one, Mark, is what you're mentioning. Make sure that the survivor receives the larger of the two benefits. You can't take both, but you take the larger of the two. Mark, what else on Social Security before we talk about other things?
You know, if you're getting to the phase of life where you're starting to think about turning on Social Security, you're starting to claim your benefit, taking into consideration the health and longevity of both you and your spouse is an important conversation, because that gets to questions around timing and optimal benefits and what this could look like if life expectancy is shorter or if life expectancy is longer. One thing that we do for all of our clients when they come in is we run a Social Security optimization report, and we have this conversation with all of our clients to build out their income plan and talk about, hey, well, when does it make sense to delay Social Security benefits and when does it not make sense?
And Mark, I'm going to just hit some small things here. Check to see if the deceased had delayed retirement credits. So if your spouse delayed past full retirement age but hasn't started Social Security, those credits can transfer to you as a survivor, and they can significantly boost your payment. Now, when it comes to taxes, we want to make sure, because we are fiduciaries to our clients, let's check to see what your new bracket is, where your brackets are, because taking Social Security is going to be important. It's going to be important to know if you're going to be pushed into a higher bracket for taxes and your Medicare, your IRMA surcharges. So you want to check to see those before you want to check to see where you stand on the tax bracket and IRMA Medicare surcharges before you decide on Social Security. Mark, anything else? I feel like we're hitting this pretty well.
You know, this question actually comes up quite a bit when it comes to filing taxes. Like, okay, let's say me and my wife, Melissa, let's say I pass away this year. How does Melissa file taxes next April? Well, the IRS allows her to file this year, 2026, as married filing jointly, because we were married during this year. And then for 2027 and 2028, so 2 years after I pass away, she files as what's called a qualifying widower. But starting in the third year, that's when she needs to start filing as single. And the tax brackets for single are much higher for single people. So if you're used to being in, let's say, an effective tax rate or a marginal tax rate of, let's say, 15 to 20%, well, it could be that you get bumped up to 22, 24% if you're single. So it's something that you got to be really aware of. How does your income situation impact you later on down the road?
Hey, Mark, I want to deviate a little bit from script here because you mentioned right away, let Social Security know that there's been the passing of your spouse or your significant other. And then the other thing that we talked about was, look and see where you're going to fall with taxes when it comes to your tax bracket and IRMA surcharges. But off script, get multiple death certificates, right? 10 to 15 certified copies. You're going to need them for banks, brokerage firms, insurance companies, real estate. You're going to need those. So that's another one high on the list, is get multiple death certificates.
Yeah.
Secure immediate cash flow. You've got to pay the bills. You've got to continue to pay the bills. Now, we at Decker Retirement Planning, we have retirement plans that show where the cash flow is coming. That is not interrupted when a client passes away. So if you're not with us, make sure that you secure immediate cash flow, that continues to pay your bills. Notify the employer, try to work out the final paycheck. Any accrued vacation and paid time off payouts, that can be significant. If you're with group life insurance, you've got to end that so that you start Medicare if you're 65 and older. Pension and survivor benefits, you've got to check to see if those are there and if they are, to pay out to you, the survivor. COBRA or retiree health coverage if you're under 65. Those are all really important. Another one, Mark, is contact the life insurance companies. So after filing claims properly, sometimes you can ask about partial advances if the processing is going to take a while, so that funds are not tied up and your income can continue. Decide where the proceeds, where they should be deposited. But the first 30 to 90 days is very, very important. Mark, before we go back on script, anything on those topics?
Just when I'm thinking about the situations that I've helped clients work through, the hardest part for the surviving spouse is consolidating a bunch of accounts that their deceased spouse had. If your deceased spouse had, an old 401k with $3,000 in it from his first employer, and he's got, maybe something with the county that he was contributing to, and he's got a bunch of IRAs and a bunch of other custodians, it's a nightmare for the surviving spouse to have to go and try to do all the paperwork and all the legwork to get these accounts updated and registered in their names and new beneficiaries and stuff. So if you're thinking, I want to make this as easy as possible on my spouse if something were to happen to me, it's so nice to have all of those accounts at one single custodian. Then you reduce the number of phone calls and emails and paperwork and online forms that you have to do just administratively. It's a blessing to your spouse to have your finances very clean and organized.
So at the end of the day, it really comes back to you having a plan. How do you want to leave things? And Brian, Mark, and the team at Decker Retirement are here to help you put that all together and have it make sense. We don't know when we're going to go. We don't know. Maybe we'll go at the same time. Maybe my dad passed away like 18 years ago and his wife's still alive. So you don't know how it's going to play out, but how are you going to leave things? You need a plan. You need a strategy. The team at Decker Retirement is here to help. 833-707-3030 if you'd like to have a conversation. 833-707-3030. No cost to you. Totally complimentary. One of the more important phone calls you can make, certainly today. 833-707-3030. Back with more with Brian and Mark right after this on Safer Retirement Radio.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833 833-707-3030. Again, that's 833-707-3030.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Mark Knaus of Decker Retirement Planning. I'm Mark Elliott. Again, the website, DeckerRetirementPlanning.com. Find out more about Brian and the team, where the offices are. All that information is on the website. You can always call with questions, 833-707-3030. I'm Mark Elliott. Glad you are with us. We're talking about not a topic that we like to think about, but certainly something we better have a plan for, and that is the loss of a spouse. So, Brian, you guys were talking about Social Security and the ramifications, and then Mark was talking about, boy, if you have things scattered all over the place and your spouse doesn't really know where it all is, it really could be a headache. Where are you going now on this topic?
We're going to keep hitting different topics here. When you lose a spouse, there's a cottage industry that when they see the obituary in the paper, they will track you down and they will make up invoices and say that you owe them for maintenance, yard work, electrical, all kinds of stuff. Don't assume you owe them. Review those debts. Be careful not to just pay, but to make sure that that's legit. Mark, let's go in this direction. So health insurance transitions, I think we covered that. But let's talk about Medicare and supplemental plans. So if someone is taking Medicare, when you stop Social Security right away, you've also got to notify Medicare and consider the changes that are made there. Mark, will you hit that one?
Yeah. So when it comes to Medicare, obviously the different plans are beneficial to different groups of people, right? Married people are going to have benefits for a couple versus a single person. You want to make sure that you're not overpaying for benefits that you don't really need. Like, let's say you're a surviving wife. Well, you don't need a policy that provides prostate cancer screening. And you just want to make sure that you're reviewing the medical coverage that you have. And also, I'd like to bring this up as well when it comes to long-term care insurance too. Is another one. A surviving spouse is at a higher likelihood of needing somebody to come in and take care of them in the house. If they don't have somebody that they're married to that can help them with their daily activities, you're going to have to hire somebody to do that. So now the discussion around long-term care becomes really important. And how are we going to have you taken care of if something were to happen to you where you're not able to take care of yourself?
So, Mark, when it comes to taxes, they've got a benefit that is now changed. So they have between date of death and 12/31 of that tax year to take advantage of married filing jointly status, because the next year they're going to go to a single status. And for most people, that means that their tax rates are going to go higher. So what are some of the things that need to be done to take advantage of the few remaining months or sometimes weeks of married filing jointly?
Right. So here, if you're in a situation where you can do some tax planning and you know that there's going to be some arbitrage from where you currently are to where you will be in the coming years, one that we look at in situations like this is doing the Roth conversion. So if we're anticipating that you're currently in a lower effective tax rate today, but then 2-3 years from now, you're going to be in a higher effective tax rate because you're going to be filing as a single filer, then we might as well do some Roth conversions in your pre-tax IRA or your 401k as a way to, get the tax growing tax-free rather than tax-deferred. Another thing you want to consider is something called a step-up in basis. So this is for your non-retirement assets. Think your house, think your joint investment account, anything that you own outside of a retirement account that has appreciated in value. You're able to take advantage of an increase in the basis of that asset, and that allows you the ability to sell that asset without incurring capital gains later on. So upon the death of one of your spouses, you're able to basically reset the basis for the asset and eliminate any capital gains that might be owed on that appreciated value of the asset.
Mark, this is important enough. Give an example.
So, for example, here in the Pacific Northwest, we run into this with real estate a lot. Let's say a husband and wife bought a house here in downtown Bellevue back in 1995, and they paid $300,000 for it, right? But now, today, that house is worth maybe $2.5 million. If they were to sell it, then they owe capital gains on millions of dollars. But if one of them were to pass away, then what they need to do is they need to find an appraiser. They need to get a appraised value for the house today, and the surviving spouse could then turn around. Maybe they want to sell and move to another state, or they want to sell and move into a condo. They don't want to do the yard work and the repair and the maintenance that comes along with owning the house anymore. They just want something very simple to live in. Well, they can sell that house without paying taxes on all the appreciated value of the house. So that's a really valuable tool for the surviving spouse to take advantage of. Brian, this is a really important one here. When we're talking about beneficiaries, we're talking about on your bank account, your investment accounts, your retirement accounts, your estate documents. This could be your trust is a really important one. Maybe if you have some kind of an LLC structure or any kind of an organized structure, all of those are going to need to be updated because the financial institutions are going to need to have proof that somebody has passed away. So that's why Brian was mentioning you want to get multiple copies of your deceased spouse's death certificates, because all these financial institutions are going to need verification that a beneficiary has passed away. So what you do is, let's say we work with Fidelity and you have some life insurance policies. You're going to contact the custodian and let them know that you need to update the beneficiary. Usually that's a form, or it can sometimes be done online. It's a really simple process. We work with all of our clients to help review all of the accounts that we're working with them on and make sure that we have updated beneficiaries on file. And then from there, we go and we look at your will and your trust. And we want to make sure that these documents are still in line with your goals and how you want your estate plan to be handled. One thing that we always caution our clients on is something in the industry, we call it widow's brain, where people have a tendency to make decisions in the first few months or even a year or two into being a widow or a widower that are more emotional in nature and maybe not logical. So working with a financial advisor and a professional who's gone through these types of situations before can really help with clearing the fog when it comes to these types of situations and getting some good sound advice.
So again, if you'd like to sit down with the team at Decker Retirement and talk about all of this, there's a lot on your plate. Certainly when you lose a spouse, there's the emotional part of that. And then, of course, it's the government saying, hey, boy, we really feel bad that you lost your spouse, but you're going to file your taxes as a single person now, and it's going to cost you a lot more in tax money, and your bills have not dropped in half. So there's a lot of things that the team at Decker Retirement are here to help walk you through. You don't have to make a lot of big decisions when you have an emotional stress like that. 833-707-3030, again, is the number to chat with the team at Decker Retirement Planning, 833-707-3030. Back with more with Brian and Mark right after this on Safer Retirement Radio.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Remember that first paycheck when you started working all those years ago? You looked at the net amount and thought, whoa, what happened here? Ah, the joy of taxes. It could be this way with your retirement accounts. You know how much you've saved, but if you haven't planned for Uncle Sam, you could come up short in retirement. With tax laws constantly changing, there's a lot you need to know to make sure you're not paying more than your fair share. Financial advisor Brian Decker and the Decker Retirement Planning Team can help you create a plan that shows you how taxes could affect you now and in the future. Set up your tax strategy session with Brian and the team at Decker Retirement Planning now. Call 833-707-3030. That's 833-707-3030. Make sure you know how these changes could affect you so you can avoid some of those whoa moments in retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
Glad you're with us today for Safer Retirement Radio with Brad Geddes of Decker Retirement Planning. Brian J. Decker not with us this week. Hope he's feeling better and be ready to go next week. You can always go to the website again to learn more, DeckerRetirementPlanning.com, find out where the offices are, find out what kind of events they've got going on. There's a lot of great information there, including there's a heading under that Decker Retirement Planning, Safer Retirement Education, where you can download a lot of different things. Sample income plan. We're talking about income today. There's a sample income plan right there on that part of the website. Safer Retirement Education is the heading on DeckerRetirementPlanning.com. I'm Mark Kelly. Glad you're with us. So Brad today is talking about income, right? There's different tools available to create our income. Systematic withdrawals is kind of the whole key to the process at Decker Retirement. Annuities are certainly an option, but you've got to pick the right one. Don't just get sold an annuity. Understand why you're getting it and does it perform the way you want to? Because we all have dollars in our retirement savings. What is their purpose, right? What do you need them to do for you? And so that's where an annuity could come in to give you that confidence that, hey, we got this amount of money coming in month after month for as long as we're here. So, all right, so there, if that's your big worry, that's a way to offset that. Dividend strategies, certainly, Brad, you were talking about that fact that, boy, when markets go down, sometimes companies got to reduce what they're paying out in a dividend. So that's a little bit of a challenge. The next one you're going to talk about is bond ladders. And bonds, back in the day, my grandparents' time, retiring in the 70s, it used to be 60% stocks, 40% bonds. And then when you got older, you flipped it and you went 60% bonds, 40% stocks. Well, in 2022, stocks and bonds were both down in the same calendar year. And it's only the third time in history, 1931, 1969, and 2022, that has happened. and it's really tied to the income. The interest rate environment is kind of how that all plays out, certainly with the bonds. But how do bond ladders fit in there? Is it like getting a CD ladder? Is that kind of the same kind of thing where we just 1 year, 3 years, 7 year, that kind of stuff?
Yeah, it really is that easy. So the way a ladder works, it's really tied. It's a way to use fixed guaranteed income sources that come from your principal, guaranteed interest, let's say. So bond ladders, CD ladders, I kind of say they're the same thing. A little bit of different taxation sometimes, but in the end, the fundamental outcome of how it's used or how it's deployed it's going to be the same. What you're doing with a bond ladder or CD ladder, I'll be using those both interchangeably, is you're buying a series of fixed income instruments. And the most classic one would be like a 5-year ladder. And the way you'd set this up, if you're using it, it ends up being good for guaranteed outcomes. All right. So you have a 1-year CD, a 2-year CD, a 3-year CD, a 4, and a 5. All right. That means that literally on day one, you will have a portion of your assets that are set up for 5 years out. And you don't really get to access that for 5 years, but it's okay. It's okay because you have the 1-year CD. And the thing that's nice about interest rates they're not as high as they were a couple of years ago, but they still are fairly high, is that these actually can be pretty useful. It's not something that's my absolute favorite. Some people might call it an investments plan or retirement plan with retirement portfolio with training wheels, but they actually do have some utility. Because at the 1-year mark, you have that first batch of maturities that come due. We can harvest or plan an amount to be drawn from that account. You mentioned systematic withdrawals. You know what amount you can draw out. You use it over the course of the next year. You take the remaining principal and you buy another 5-year maturity. This can be done quarterly basis, 3-year basis. There's all sorts of ways to do it, but let's just say 5 years. Second year comes around and same thing happens. You had that 2-year CD mature, you draw out the amount that we had planned on. You had the growth that was guaranteed for 2 years, and you take the remaining proceeds and you buy another 5-year CD. Walk through that process and this laddering, you end up in a position where eventually you have 5-year maturities constantly in motion, and you take whatever planned income out that you needed or wanted to use, and you invest the proceeds in that 5-year time frame. Bond laddering and CD laddering is very useful because it has certainty of outcomes. It has a lot of liquidity on an annual basis, being able to access not all of it, but portions of it. The problem with bond ladders and CD ladders is that you're going to be in situations where interest rates decline. You see rates that go down, and this is what we experienced. We are currently experiencing that, where you buy in and the initial ladder is set up at rates that are very attractive. And while the long-term rates are going to lock in those rates for the long term, the shorter term ones end up getting rolled over or renew at a lower rate. And so what might have been acceptable initially can gradually become less and less acceptable down the road, and people might be disappointed at the rates at which they are going to mature. That there, to me, is my biggest reason for trying to steer clear of bond and CD ladders in this interest rate environment where rates are more likely to go down than they are to go up, because we've just hit peak interest rates a couple of years back and things have been trending lower. So bond ladders, useful, very good planning tool, probably going to be on the lower end of overall return efficiency, but very good at creating guarantees and certainty against a decline in let's say poor market conditions that we will encounter at some point over a 20 or 30 year horizon. This is a very useful way of getting away from that risk. I know we've talked about a ton on the show as that sequence of returns risk. You fully neutralize that sequence of returns risk using something like a CD ladder or a bond ladder with those sequence with those maturities all laddered out so that you have that series of known income at different points in the future.
Hey, Brad, we've talked about this before on the show, but maybe somebody listening today has not heard you talk about this or Brian talk about this. Talk about the interest rate and how they're tied to bonds. They're like a teeter-totter. They work opposite of each other, right?
That's right. Oh, man. Yeah, it's a big one for us as a firm. All my clients understand it. I talked to them about that early on. Because unfortunately, a lot of advisors don't go through the effort to build out, let's say, a bond ladder. All right, bond ladder is going to have known dates. You're going to have return of your principal. You have the growth coming from the coupon. It's a guaranteed strategy. Unfortunately, what a lot of advisors do is they'll go out and just buy a simple bond fund. A bond fund ends up being occupying the role of supposed safety as a counterweight to the supposedly much more risky stocks that you have in a portion that's meant for longer term growth, longer term accumulation. And I never ever would want someone to confuse a bond ladder or a CD ladder with their bond funds. Bonds themselves, and CDs is a very similar example, are going to have guaranteed outcomes. You get your money back, you get a guaranteed rate of return in that time frame. A bond fund is a market-based instrument where there are a certain number of shares, and those shares trade hands daily. And it's going to reflect the market's perspective as to whether those bonds in that fund are attractive or not. Now, this kind of market dynamic is everything we're trying to get our clients away from. We want our clients to be certain that they're never, ever, ever drawing income from what we call a fluctuating account. So a fluctuating account is just like your 401k. When you log in there and you're working, some days you log in, it's green, we're happy, that's great. Want as many of those days under our belt as we can, but we're tolerant of the days where that account is lower, it's down, and you stay the course. People sometimes are surprised to learn that if they go and look up any of the bond funds they've used for the last 5 years, it probably was one of the worst performing asset classes in their portfolio at a time where gold is hitting all-time highs, right? Stocks pretty well near all-time highs. We've had a bit of chop in the start of 2026. These bond funds have just dependably been some of the worst performing holdings on portfolios that I've analyzed or looked at and helped devise an investment strategy around. So a bond ladder, bond fund are not the same thing. A bond fund is a market-based instrument that can have extreme periods of losses that you don't want to confuse with using actual bond instruments or even financial products, things like CDs or MYGAs or other things that actually guarantee you against losses.
So when you think about the bond world compared to the interest rates, if the interest rates go up, bond values go down. If interest rates come down, bond values go up. There's a lot of what ifs. You don't want your income to be a what if scenario. 833-707-3030 is the number again to talk with Brad, Brian, and the team at Decker Retirement Planning. 833-707-3030. There's no cost for this. The next income tool would be rental income. That's kind of a great thing if you've got a great renter. Problem if you don't have a consistent paying rentee.
Yeah, no, it's funny you say that. I always laugh with rental income because I think back in the early 2000s with books like Rich Dad, Poor Dad, and low interest rates from that ultimately led to 2007, 2008 financial crisis. We saw things like mortgages go the wrong direction. Rental income was sometimes referred to as passive income. And some of my wealthiest clients contest their rental properties are not passive. There's actually extended periods of vacancies, or let's say there's repairs that they need to do, and it can be quite expensive. So rental income is actually really great, especially when people really know the market they're in and they know how to manage it. But one thing I have never had a client do is go out and seek buying a rental property as a way of planning out income. The problem I see here with people have not already had the rental property for years and years and years is that flywheel of cash flow efficient investing takes a long time to build up. And so the rental property, buying it now and thinking that it's all of a sudden going to be cash flow positive a year from now is sometimes just not possible. And rental properties in retirement, it can include a lot more work than people would like to have when they're really trying to be a bit more carefree and just enjoy the 30 or 40 years that they spent working. And you do want to be considering different sources of income. So I like the diversification of rental properties, especially when people accumulated them a long time ago. But sometimes I talk to my clients about, hey, you might actually be kind of bored when you're retired. There's some people I meet, lawyers and people that did a lot of really fun things, and all of a sudden they're retired, and sitting on a beach with a Mai Tai sounds great when you're working, but that becomes your daily life. Sometimes there's a little bit of lack of fulfillment. Maybe they want a little bit more social interaction and maybe just a little extra cash flow. And this is where I like to bring up that part-time work sometimes is really useful in retirement. It actually does help make a portfolio last a lot longer when you can complement some of those other income sources, including distributions from your portfolio, with some form of earned income. It's I think quite helpful, especially when maybe someone's retirement is a little tighter, right? They didn't quite reach their perfect fat retirement goal of a huge amount in savings. It's, they got Social Security, they got a good amount of assets, but they're still kind of a little bit close on actually being able to fully enjoy retirement. And that's where sometimes just some part-time work, at anything from consulting in the job that they were at prior to retiring, or all the way down to maybe someone always dreamed of, getting paid minimum wage, working at their favorite 501c3 organization. I've seen them all. But they are sometimes the reason someone is able to retire comfortably and be very happy, comes from that added option of considering maybe some part-time work at a time when they might consider themselves actually retired.
And part-time work is certainly, if you don't like working 40 hours a week, but you're kind of like, I don't really want to do nothing. I can't play golf every day. Well, I think you're mistaken. I think you could, and you should. But I'm not retired yet, so I don't know. I guess I'll find out actually if I can do that when I retire. But at the end of the day, where's your income going to come from? How much do you need? How do you know how long it'll last? All those questions. The team at Decker Retirement are here to help you figure that out. Again, the number. There's no cost for this. I don't know why you wouldn't take advantage, at least to get some clarity into your situation. I think that's the number one thing you get out of this conversation with the team at Decker Retirement Planning is clarity. Where are you? Can we retire? Well, when? Do we have enough? All those questions you have. 833-707-3030. 833-707-3030. Our final segment with Brad Geddes of Decker Retirement. Coming up next, we're talking some more income tools as we wrap up today's show. Stay with us. Back with our final segment right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brad Geddes of Decker Retirement Planning. Brian J. Decker not with us today. A little under the weather. Hope Brian's going to be doing all right. Be back with us next week. But again, the website's DeckerRetirementPlanning.com. There is that section on that website under the heading of Safer Retirement Education, those things you could download, including Brian's book on retirement, The Decker Approach. But we're talking income today. There's also a sample income plan on that part of the website, Safer Retirement Education. Download it. Go walk through it. See where you are. Then maybe call the team because you got some questions. 833-707-3030. 833-707-3030. I'm Mark Kelly. Glad you're with us today. Brad's been going through income tools, building that reliable retirement income that we all really need. And it's kind of like, well, when can we retire? Have we saved enough? Will it last? That all comes kind of back to income to a degree. So your final segment, Brad, talking about all these different ways to create income. There's certainly a lot of what ifs in retirement. So you're going to start off this segment with kind of talking about combining multiple income sources, right?
That's right. And I think, again, back to your analogy of using the house, there is no one perfect investment that someone ought to consider in order to make their retirement dreams become a reality. It's often more of a team effort. And the team effort comes from being crystal clear on where is money going to come from that's recurring in nature. Pensions, Social Security. Maybe we could lump in some some of the rental income that we want to assume is in there. But you start to total all of these up and take an inventory of how much of your baseline monthly income is actually covered from this monthly recurring and hopefully inflation adjusted regular sources of cash flow. These are gold. These are gold as part of being a financial planner, because what I do is we look at that and then we know that there's a gap. There's a gap that needs to be filled. Not everyone has a gap. Sometimes those fixed income sources have they're large enough that people, let's say, it can cover the majority of the income that they need, and that income is perfect. It's adequate. More than enough comes from those. That's great. Makes it pretty easy as an advisor to plan. But more often than not, their portfolio that's been accumulated has to occupy a pretty substantial portion of their monthly income, and clients don't want to mess it up. And so we use that last piece, that financial assets base, to fill in any gap in income. And I mentioned in the beginning, my favorite technique to start with is maximum income. Right? Sometimes people come through after many reviews with other advisors they're interviewing, and they're surprised that I don't talk too much about their budget or their needs very early on. Instead, I want to know mainly what's the most amount of cash flow we can distribute. I present that to them and sort of has just say, is that enough? And when it is enough, that's great. Perfect. Sometimes people say, holy cow, that's way more than I thought was possible. Well, great. That's actually very useful information. We have probably some surplus in here. In some cases, it's not quite there. It's not quite enough. It's, if we're close, or maybe we're not even close. At that point, you can start to factor in other strategies like looking at home equity a little different. You look at home equity and say, look, this is the place you want to pass on to kids and grandkids, then this house is off the table. But hey, if this is a 3-floor walk-up building in a major city, you're probably not going to be living there in your mid to late 80s, and maybe anticipating a home sale down the road and factoring that into your income plan is going to be useful. Or maybe we just assume a little bit of part-time work, right? You fill in that gap with portfolio income, and then you have a little bit of part-time work for a few years. And like I said, there's some other aspects of part-time work that I've found pretty useful in both portfolio strategy, but also in things like just quality of life and keeping people active while they're young. I think by and large, though, when I'm building an investment strategy for our clients, and this is what we do here, it starts with the plan. All of my clients have some form of an income plan. We know where money is going to come from. We know why it's invested the way that it is, and how much, of course, can be distributed. And it comes back to that investment philosophy we have here of trying to avoid sequence of returns risk early on in our clients' retirement. And it's a term that we use a lot here, principal guaranteed assets or principal guaranteed accounts. This is really the foundation of my clients' income from their portfolio. Anything that is protected against a major downturn is going to be the first place we want to allocate funds for different phases of their life. If something is going to be used in the next 1 to 2 years, well, that's going to be very liquid, very probably on the lower side of the yield curve, smaller rates of return, but it's because we're using it. Now, as you go down the line, you start to say, okay, this is money we don't need for 5 years or 7 years or 10 years, or this is money I don't need until I'm 15 years older than I am today and I'm 80 years old. Well, that's investable insight that we get from our clients that we're working with and building a plan. But the principle never changes. We're always going to be drawing from principal protected income sources and harvesting harvesting income from those, so that we know that the market is not going to dictate whether a client can successfully retire or not. We don't want to have our clients riding that roller coaster, drawing from a fluctuating account like most other advisors are doing, and just hoping that we don't have another 2008 financial crisis. Now, as you start to get a little further in the planning, something people start to realize is that there's a lot more benefit to how income is going to be distributed, and some of the outcome, some of the way that the benefits of being that diligent on planning out income sources. And it leads me to taxes. So when you're building an income plan, we know we're able to actually anticipate what the taxability of those withdrawals is going to be, and we can strategically allocate funds to lower client taxes over the course of their entire lifetime by simply planning out where is the best place to position, let's say, an IRA that has higher taxes than, say, their Roth IRA, which is lower taxes, or even just their trust or something down the road of drawing money from a trust either early on or later. No, that's kind of looking forward to some of the extra benefits of planning out income. But really, the bottom line, what we're trying to do here is create an income stream that maximizes the potential benefit that someone can draw from their financial assets over the course of 30 or sometimes even 40 or more years. Maximizing that cash flow is my favorite metric. Whether or not a client draws them out or not is quite useful. And like I said, making sure that money lasts for 30 or more years.
So when you think about the 30 years or so of if somebody retires at 65, as you said, you're going to plan to 100. So that's 35 years of planning. Is it kind of like bucket strategy where you got, here's the money you need now for the first 5 years. Here's another bucket for 6 through 10, 11 through 15, 16, so on. Is that kind of, to dumb it down a little bit for me? Is that kind of how that works?
It's funny. There's so many different terms that get shared across different strategies. The bucket strategy is indeed what we do. We do create segments. I call them sleeves. I have groups of assets that are used within particular timeframes. What it's not, now you just have to draw these conclusions, say, look, this is not going to be bucketing based on, let's say, tax type, or bucketing based on here's your bond funds and here's your stocks. It's a little different. It's more about time horizon. So when we're creating segments of our clients' assets, we're paying very close attention to how we ought to invest those dollars in order to achieve the best possible rate of return that we can for that time horizon. And the time horizon is so useful. Like I said earlier, 1 to 2 years out is a very different investment strategy than the assets that I can definitively say my clients won't need that for 20 years. Very different investment techniques, yet most advisors are going to come in and use a one size fits all and just say everything is going to be approximately within line of what your stated tax preferences are. This really gets to the crux of what the difference is between, let's say, like the pie chart approach that a lot of people are familiar with and advisors use very commonly. So we grow kind of numb to its deficiencies when we're building income plans. Pie charts are fully fluctuating in their value. You log in on any given day and you're going to see big declines or you see big gains. And it's not a good way to distribute funds. Instead of going top down, if you go bottoms up, building a plan, an investment strategy that can be executed using principal guaranteed assets that are aligned with the other income sources that are very knowable, plannable, things like Social Security, rental, any potential income someone's earned. What you end up with is an actual plan for how to use and how to get the most out of your financial assets over 30 plus years. And that's what we think is the foundation of what most people spend a lifetime accumulating their assets for, is to use their money. What you said, well, that the purpose of the money, a purpose behind why they spent so many years accumulating these assets is what we're trying to align with our clients as we devise an seed strategy to last a lifetime.
So if you think back to where Brad started this conversation about income, right? Building reliable retirement income starts with, okay, what is the maximum you can withdraw from your accounts month after month? And then you go from there. As long as you don't go over that, and if you do go over that, then we got to make some adjustments, but hopefully you just stay within that and you're going to be fine. But do you know that number? Do you have an idea where you are? That's why it's so important to sit down with a retirement planning team. Nothing against the brokers out there that are helping you grow your money, because that's important. You got to grow your money. But when you get to retirement, that IRA, that 401k is not a retirement plan. It's an important tool in putting a plan together. But those aren't plans. Those are just tools that help build the plan. So it's income, investment, taxes, healthcare, legacy planning, Social Security, Medicare, all those decisions that you have to make. The team at Decker Retirement is here to help you figure all of that out. At the end of the day, it's your money, it's your retirement, it's your hopes and dreams. How can Brad and the team at Decker Retirement help? 833-707-3030, 833-707-3030. No cost to you. I don't know why you wouldn't take advantage. I think it's one of the more important opportunities you have when we are talking about the next 20, 30 plus years of your life. Getting you some clarity into your retirement picture. 833-707-3030. And again, the website, Decker Retirement Planning, under the heading of Safer Retirement Education. You get Brian's book on retirement, The Decker Approach, plus the sample income plan. It's all there. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. So again, that number, 833-707-3030. Brad, appreciate you going solo today. We thought Brian would be alone, but he's a little under the weather, so nice job. Enjoy the rest of the weekend. And Brian will be back probably with us next week right here on Safer Retirement Radio.
Excellent. Thanks, Mark.
security, and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.